Hi, this is Ray Schoonover. It is May 15th, and looking to offer a message here about how to increase the probability of investment success for anyone, really. And the best way to do it is through investigating and understanding how markets work, because in learning about things that you may not have known before can lie an edge. Wanted to talk a little bit about dealing with maybe what I would call the elephant in the room, which is the lotto mentality that's out there. I've been managing investment portfolios for a living now for about 35 years, and I can tell you that most people have their head on a little screwy when it comes to managing risk and return, even though it's their money, and clearly they are looking out for their own best interest. But many times their temperament doesn't allow them to exactly do that. And it's the idea that they're looking to always buy, or many times buy, the possibility of great returns instead of looking for how to get the probability of good returns. And so a good example of this, I call it the lotto mentality, is, hey, please turn my $2, my low-risk investment, into unlimited returns, 167.3 million by next Saturday, please, if that's okay. And that $2 into 167.3 million happens to be what the Texas lottery, I think, is returning this Saturday. So the idea here is that somebody is generally going to win that, but it probably isn't going to be you. And so when we are keeping astronomically high unlimited returns intact and trying to limit our risk, inadvertently what we're doing, we need to understand, is lowering our probability for success. That is the elephant in the room, that we're dealing with possibilities more often than probabilities. And what I want to talk about is how dealing with a second way of profiting. The conventional first way of profiting is directionally speaking. We generally try to buy low and sell high. That's where we have the possibility of unlimited returns and the limited risk to zero. But we have a second way of generating a profit that we can do in combination with the first, not necessarily just instead of. So basically, if we own a stock, we own volatility. And I want to be clear here that we employ all of the conventional ways of managing risk and return on a directional basis, which is diversifying, having a long-term time horizon, using pre-tax dollars when we can, using tax-deferred dollars when we can, professional money management for stock selection and evaluation and trend identification is important, dollar cost averaging, and regular rebalancing of our diversification are certain things we can do, but they can they only do so much in terms of providing us odds for success. And so that's why I wanted to enter into the basics of selling volatility and share this concept with you, because we start to realize how we can actually employ short-term time on our side to give us higher probabilities of success in our investment portfolio. As I mentioned earlier, if you own stock or securities, you also own volatility. You own an unlimited upside. You own risk to zero, but you also own volatility. And we want to show you how to profit from volatility instead of having it make you be afraid. What we're looking at when we do this is, instead of on a directional basis where we're focusing on what we can't control, and what seemingly conventional investment advice tends to only focus on, selling volatility allows us to concentrate on lowering risk, lowering cost basis, dealing with putting time on our side on a short-term basis even, and altering our behavior to think in terms of more in terms of putting probabilities on our side as opposed to possibilities of making gains. So one of the beautiful things about selling volatility is it puts two things that will never change on our side. Part of the problem with directional investments is we have to predict something to occur, and then it has to occur, and then we have to predict that that's all there is, and those gains are adequate, and so we're going to sell it. So we have to kind of be right twice. But when it comes to selling volatility, we take advantage of two constants that never change. One is that stocks fluctuate, and the other is that time passes. We're experts in auction markets. That's, I think, what makes us different. And recognizing that stocks don't always go up and they don't always go down, but they always go up and down, and it is part of the reason why selling volatility has a higher probability of helping us enhance our long-term core investment goals for profitability. If we're looking at this, we see the blue diagram to the right shows an example of time and a range of potential subset prices that could fall in that blue area that are going to occur within a particular, in this case, 68% of the time. And so that can help us make determinations about how and where and when to sell volatility. As I had mentioned earlier, there's two ways to profit. On the top end of the black line that goes from 0 to 75, we have the traditional buy low, sell high directional approach, which is directionally dependent for success. And then we have the sell volatility approach, which is to basically do something that may be foreign to a lot of people. And I'm going to share with you kind of how this works right now, where we can actually profit if the underlying price stays within a range, either up or down. So imagine your portfolio generating profits no matter whether stocks are going up or down. This idea of a second way to profit is somewhat similar to, let's say you're a real estate tycoon and you own a commercial building or apartment complex. You wouldn't just buy ostensibly low, looking to sell high in 10 years for a capital gain. Over the period of time that you own the building, you would run out of space. Well, similarly, volatility is the analogy to space in real estate. We can sell it in return for premiums to generate additional cash flow that can help us offset the cost of our original investment. So selling premium can enhance your total return while increasing your probability of success. What we do is combine short-term management strategies like selling volatility with long-term investments like finding good quality core growth companies to continually improve the investment basis of through this idea of actively selling volatility. So let me share how this idea of selling volatility works. On the left we see that we can buy low and sell high. That's directionally oriented and directionally dependent upon success. But volatility is more omnidirectional. I'm going to give you an example here. If we look at a stock here, in this particular case, it really doesn't matter what it is, but this particular conduit here is somewhere just north of $45. What we are able to do when we sell volatility is sell a price where the stock isn't. In other words, we are looking to sell in this position right here all of the upside above 65, which means that we have $20 worth of gain if we own it at $45 before we have to sell it. And if we sell the 65 call, all the upside above 65, we're going to get to collect 92 cents or $92 for every 100 shares that we own. So it's still a bullish strategy to sell an out-of-the-money call because we get to profit all the way up to $65. We lose any upside above 65, and so you may say, well, why would I ever do that? And the reason why is because you get to collect 92 cents for something that's very unlikely to occur. As a matter of fact, may only occur about 80-some-odd% of the time. Similarly, we could sell a $20 out of the money worth of downside, which means that we have to buy more stock at $25. The stock is currently $45. We may be more than willing to buy more stock at $20 or at $25, or we may not own the stock at all and just decide that we want to sell a 25 put, and that because that's where we might like to own it. And in order to do that, we collect 57.5 cents or $58 for the obligation that we would have to buy that at 25 if the stock moved from 45 below 25 to make us have to buy that. So what we're really talking about here is, in this particular case, we could sell upside. We could sell the idea that we have to buy more stock on downside of a. But basically, we're looking at a $40 range here. That as long as this particular stock were to be within that range, we're going to collect $150 for every 100 shares, 84% of the time. Generally speaking, we can be looking at somewhere between 10 and 20% returns if we don't even own the stock and if we're just selling what we would call a strangle in our range bound. So the markets give us the ability to make a considerable amount of money over a short period of time, in this case 55 days, and we always have the opportunity of taking our profits sooner than that if time allows what we call these wasting assets to trickle away faster than we may have thought. So again, imagine your portfolio generating profits no matter whether stocks are going up or down. We think when you know better, you do better, and so investing the time to understand how auction markets work and are different, I think is a super way to try to gain an edge. The net effect of all of this is to try to improve your core positions, your core investment positions, to improve the investment basis over time with a second way of profiting. This ultimately gives you a benefit of a higher compounding rate. If you're looking at 8% over 10 years, normally on a $100,000 investment, you would see that grow to $215,892. But just by adding 4% to, instead of 8% growing to 12%, you would see an additional $94,693 in total return. So that would be $100,000 to $310,585. That's a pretty nice way of getting 50% more bang for your buck. We are S2O Capital Management. We're a registered investment advisory firm. We're investment fiduciaries. We don't sell product. We or accept commissions. We manage multi-style, multi-capitalized financial assets, and we pursue positive total return in all markets. So that is our objective. We use a separate custodian for client assets, and many of the strategies we use the selling volatility strategies are option strategies, and as a result, you should know options involve a certain amount of risk. What I would encourage you to do, if you have questions, is to look at my email, shoot me an email, or pick up the phone and give me a call. Certainly on the left side, by all means, you can check us out at our website. We'd look forward to helping you if this seems like something you'd like to at least learn more about, and we'd be delighted to offer any assistance.